Hey guys, it's Elliot for the Keystone Financial Academy. So we all go shopping occasionally at big box stores, right? Whether it's Costco, Target, Sam's Club, Walmart, or whatever else is out there, they're fairly cheap and carry just about anything you need. Now imagine walking into your favorite box store and seeing that everything they sell is suddenly at least 10% off or even 20% off. So what would you do? Would you turn around and walk out saying, nah, I'm not gonna shop these silly discounts. I only purchase things at full price? No, of course not. You're gonna grab the shopping cart and load up on everything you buy anyway, but get twice as many of each item because, hey, it's being offered at a steep discount. Clearly, people love stuff on sale, and some even line up in the middle of the night to be among the first in a store as it opens to load up during that once-a-year Black Friday sale. Now, that's not my thing. I value my time too much, but I digress. So if people love sales so much, why don't they get excited when stocks are offered at a discount? Well, a lot of savvy investors do get excited about a down market, and so should you. It's what we have going on right now, as pessimism and uncertainty surrounding inflation, the coming interest rate hikes, the future of the coronavirus, corporate earnings, and other economic news has driven the S&P 500, the Dow, and especially the Nasdaq towards some rather unwelcome lows, and some say into correction territory. But what's really going on here as far as you, the investor, is concerned? What's happening is that a lot of stocks are suddenly on sale, and it's a welcome buying opportunity and not a reason to sell. Now that statement comes with some caveats. Not everything that dips in price is of course a buying opportunity. In some cases, the stocks really were from junk companies or terribly overvalued and not worth loading up on at any price. However, if you're a careful investor who prefers to stay away from speculative stocks and instead buys quality blue chip value growth or dividend stocks from solid companies, you have nothing to worry about, as a down market just opens up opportunities to buy more stock. And here's why. The stock market is driven much more by fear, greed, and investor mood and sentiment versus any logical thinking. Everyone is selling right now, and this causes equities markets and all the indices to drop. Why is everyone selling though? Mostly because of irrational fears of pending doom and gloom and getting caught up in the mass hysteria of investors selling to avoid further losses. But if you take a closer look at the top quality companies whose stocks are getting beat up in the sell-off, the vast majority remain top-notch, profitable, and valuable organizations, and their stock is just getting caught up in the selling even though the company's core businesses are still fundamentally sound or just facing temporary and insignificant dips. Now is exactly the time to buy more shares and not sell your holdings. Now, what if you don't pick and choose individual stocks, but instead invest in index funds and ETFs such as the ones that follow the S&P 500? Well, first off, good on you for following this highly recommended strategy, and in this case, you should especially double down and buy more shares. The S&P 500 is the broader market, and historically it has always gone up, averaging 10% per year if taken over the long haul. If you don't need access to this money soon, then ignore any downturns and just pick up more shares when the prices are down. Now remember, I said earlier that there were a few caveats to all of this, and the second caveat has to do with your time horizon. If you do in fact plan to retire shortly and will need to access this money soon, then a downturn and even temporary losses will certainly not be in your best interest. However, no one near retirement age should have all their money tied up in equities anyway, and you should have moved most of it to safer investments such as US Treasuries and other instruments. And this is something any financial planner should advise you to do long before you get close to retirement age. For those of us who still have a lot of income producing and investing years left, remember the quote shown at the beginning of this video. Be fearful and stay away when everyone else is being greedy, buying in a rising market, and conversely be greedy and buy when everyone else is fearful of a downturn, selling in a falling market. Remember, if you're a thoughtful investor and put your money only into quality, value, growth, and dividend stocks, then any dip in the share prices is a buying, not a selling opportunity. And if you don't believe me, well, this was the cornerstone philosophy of Warren Buffett, currently the 6th richest person on earth. So take the advice for what it's worth. Okay, everybody, invest wisely, and until next time.